Now, I'm sure that all of you already know Chris Klein, though Chris Klein also recently took on a new role at Guy Carpenter. He is now the global head of reinsurance markets, responsible for the development of Guy Carpenter's relationships and strategies with global reinsurance markets. He continues to be a trusted source of commentary on the market, and I am pleased indeed that he could join us here today. With that, allow me to give the podium to Chris Klein, who will discuss the state of the reinsurance market, not to mention the significant changes in capital levels from just a year ago. Chris?
Thank you, Henry. Ladies and gentlemen, it's a pleasure to be with you again this year. Now, last year, as Henry mentioned, we discussed the unexpected recovery of the reinsurance market from the financial crisis of 2008. As capital levels rebounded their way back, we forecasted flat or lower pricing at the January 2010 renewal, as the increase in capital outstripped demand growth. Such was the case. Further erosion of rates was evident at the principal renewal points in 2010, despite above-average catastrophe losses during the first half of the year. It almost feels like 2007 all over again. Rates are falling. There is plenty of capital in the industry, and reinsurers are trying to figure out what to do with it. Total earnings for the Guy Carpenter Reinsurance Composite in the first half of 2010 decreased by 6.4% to $4.8 billion compared with the same period in 2009. The principal driver was an underwriting loss of $901 million compared with a profit of $2.4 billion for the same period last year. Much higher catastrophe losses in 2010, estimated at some $22 billion for the insurance and reinsurance sector, cost our reinsurance composite $6.1 billion, with substantial losses from the Chile earthquake, the windstorm Xynthia in Europe, and the Deepwater Horizon rig loss. However, the underwriting deficit would have been much worse if not for the continued mitigation from prior years' loss reserves releases that generated double-digit savings to loss ratios in some cases. The weighted average combined ratio of the composite increased from 92.1% to 102.5%, the highest since 2005, the year in which the KRW hurricanes struck. Earnings were also rescued by realized investment gains. Gains of $2.5 billion were harvested during the first half of 2010 compared with losses of $1.5 billion in 2009. This reversal provided a substantial offset to the underwriting deficit, helping the annualized average return on equity to tick up to 13.2% from 12.4%. ROE also increased because shareholders' funds decreased by 0.8% to $109 billion between the 31st of December 2009 and the 30th of June 2010. The increase in shareholders' funds that came from retained earnings and the unrealized increase in asset values was offset by share buybacks, dividends, and currency effects. But the aggregate value of shareholders' funds at the end of the first half of 2010 was almost identical to December 2007, as you can see in the chart. Now, Guy Carpenter estimates that the reinsurance sector held excess capital of approximately 8% at the end of the first half of 2010. So what has this meant for market conditions? Well, at the 1st of July renewal, we observed risk-adjusted price decreases in the range of 10 to 15% for the very important US property catastrophe renewal. And a recent study of Guy Carpenter's US nationwide property catastrophe renewals throughout 2010 revealed that the total sum of authorized lines, authorized capacity, in 2010 was 38% higher than the total of the expiring authorised lines in 2009. So it should come as no surprise that the average signing rate was 84% this year, compared with 94% in 2009. US casualty lines also continued to demonstrate lower pricing, and workers' compensation capacity remained abundant. Capacity for international casualty was also plentiful, reflecting overcapitalisation and new entrants to the market seeking diversification. Where price increases were achieved, this was mainly due to specific loss experience, most noticeably and unsurprisingly in Chile and the marine and energy sector. And so where do we expect the market to go? The answer, as always, depends upon how the wind blows, among other loss experiences. Several underwriters have either exhausted or expended a substantial portion of their 2010 catastrophe loss budgets. Now, this might lead to some spot purchasing of reinsurance or retrocession to cap losses before the end of the year. More broadly, absent a market-changing event, we expect pricing to continue to drift downwards, except where there has been meaningful loss experience. So what might turn this market? Many believe it's the size of the loss that might alter the trend. A mega cat, for instance, would have an impact. But I rather think that the market is more likely to respond to a surprise cat loss. The 11th of September terrorist attacks had a profound effect on the market, not just because of its magnitude, but also because it exposed hitherto unknown correlations and clashes. In 2004, a series of 4 hurricanes hit the United States in quick succession, reminding us that frequency was a risk that had not disappeared. And similarly, in addition to being a huge loss, Hurricane Katrina revealed widespread deficiencies in the way exposure accumulation was controlled. We may be well tuned to cope with windstorms, but could a serious earthquake in a peak zone cause a surprise because experience is dated? Or what if we experienced a sudden increase in the frequency of catastrophes, such as a series of earthquakes, or say 3 major consecutive hurricanes? In the medium term, factors that could put upwards pressure on pricing continue to lurk in the wings. Support from reserve releases appears to be waning, and our analysis of statutory data for the US P&C industry already reveals modest adverse development for the 2008 accident year in 2009. You can see that in this chart. Investment returns remain low, aggravated by bigger holdings of cash on balance sheets, whilst in some countries the threat of inflation is growing. Regulatory initiatives, such as Solvency II, also threaten to increase the cost of capital. This could provide the dual stimuli of rising prices to cover the increased cost of capital and increased demand for reinsurance that can provide relatively simple and quick relief against higher capital costs. Meanwhile, reinsurers have responded to excess capacity through consolidation and active capital management. They have tried to increase leverage through dividends, share buybacks, and substitutions with cheaper debt. Whilst these measures might provide immediate relief to managements under pressure to maintain returns, are they what shareholders really want, especially those of a longer-term disposition? Returning capital provides some measure of relief relative to attaining return on equity targets, but it also comes at the expense of future growth.